In this free video course, you will learn everything you need to learn about the basics of technical analysis in a structured simple to follow step-by-step way. We'll begin with a simple introduction to what technical analysis is and its goals, and then we'll jump right to the main techniques for beginners. By the end of this course, you should be able to combine different basic techniques to produce good trades on your own, and then you'll be ready to continue your trading education with other techniques for intermediate and advanced traders. If you're new to this channel, make sure you click the like button, subscribe to the channel and activate the notifications button. Also, don't forget to subscribe to my Telegram channel where I share absolutely free signals and 100% working strategies. By doing this, you support the ongoing creation of free videos like this one. Let's begin with the definition of technical analysis. Technical analysis is the use of price charts to identify repeatable patterns in past price information in order to forecast the future of price. That allows traders to identify trade opportunities where they can buy low and sell high, which is the main goal of a trader. Technical analysis only works because the financial markets are made of repeatable patterns. When a trader is able to spot a known pattern developing in real time, he's able to know what's going to happen with the future of price. In other words, technical analysis is all about learning how to spot the many different repeatable patterns of the market. In this course, you'll learn the most basic of these patterns. Keep in mind that there are many more patterns from beginner to advanced level. The main tool of technical analysis is the price chart. So, let's quickly explore the main features of the price chart. As a beginner, you must know 4 elements of price: charts, the symbol or instrument, the type, the time frame, and the auxiliary tools you can add to the price chart to enhance your analysis. The symbol, also known as the instrument, is the markets you want to trade. For example, in a trading view you can choose between stocks, futures, forex, crypto, and so on. These are the different types of symbols. Let's say you want to trade forex. You click on the forex tab and then a list of 4 symbols. By clicking in one of them, like the Euro USD, you will open the Euro USD price chart. The next element of price charts you must know is the type of price chart. There are many different ways of displaying price information. In the chart, the vast majority of traders use the candlestick charts because it's very useful. But as you can see here, there are many other types of price charts. As you progress throughout this course, you'll understand why most traders choose the candlestick chart to trade. It has many useful properties that are also easy to use. Each one of these bars that appear in the chart is a candlestick, and we'll talk a lot about them. Notice that the x-axis of the chart represents the passage of time, and the y-axis of the chart represents price fluctuation. The next thing you must know about price charts is the time frame. The time frame of your price chart controls how much time it takes for a candlestick to form. For example, if you are in the 1-hour chart of the Euro USD, that means that each candlestick in this chart takes exactly 1 hour to form. When 1 hour passes by another, candlestick begins to form on the chart. As you can see here, there are many time frame options you can choose from, 1 second all the way up to 1 month. In a 1 second time frame, each candlestick will take 1 second to form. In a monthly time frame, each candlestick will take 1 month to form. Notice that you can see the same symbol or instrument. In many different time frames, the daily time frame will practically be a different market than the 1-minute time frame, even when we're talking about the same symbol. The time frame you will choose depends on how much time you want to wait for the opportunities to align, how fast you can analyze the market in real time, and how much time you have at your disposal in order to trade. In a very fast time frame, like the 1 minute for example, the market develops very quickly, so you must be very skilled. In a slower time frame, like the 4-hour for example, the market develops slowly, so you have a lot of time to think about your analysis and trade decisions. It is also important to notice that the smaller the time frame, the smaller the price movements. So even though a time frame like the 1 minute develops quickly, the size of price movements is small. A time frame like the daily, for example, develops slowly, but the price movements are much greater. The last element of price charts you must know is that beyond price itself, which is formed by the candlesticks, traders will often add another tool to enhance their capacity to analyze the market and detect the repeatable patterns I mentioned previously. There are mainly 2 ways of doing this. We have what were called overlay tools and we have window oscillators. Overlay tools are any type of technical indicator or line that is plotted on top of price. For example, I can plot technical indicators which are mathematical formulas applied to price, like moving averages and Bollinger Bands. You can do this by opening the Indicators tab and then selecting the technical indicator you want to use. Notice that these indicators are plotted on top of price, that's why they are called overlay tools. There are other types of overlay tools that are not technical indicators. There are different types of lines like horizontal lines or sloped lines. For example, I can also make use of oscillators, which are technical indicators that are displayed in a separate window, usually below price. This is the case with indicators like the RCI, the MAC, or the stochastic indicator. For example, you open these in the same way that you open the overlay tools, which is by clicking on the Indicators tab. And then selecting the oscillator of your choice, there is another interesting possibility. Here, I'm going to briefly show you to spark your curiosity, even though this is not exactly a beginner's thing. You can also use overlay tools on top of oscillators instead of price. For example, you can draw different types of lines or even apply different types of indicators on top of oscillators. There are hundreds of possible combinations and techniques here, but that's a subject for another video. For now, I just want you to know that you can apply different tools on top of candlesticks or below them. In order to enhance your analysis in this course, you'll learn a few of the simple ways of doing that effectively. The next step here is to learn more about the fundamental piece of price charts, which is the candlestick. Candlestick. There is a lot of useful information contained in candlesticks, and by understanding how to read this information, you will be able to gain further insights about the markets you want to trade. This is the first step in learning how to identify the repeatable patterns of the markets. Let's begin with the very basics of candlesticks. Any kind of stick is formed by four values, also known as four prices. These are the open, the high, the low, and the close. Remember that I said that the time frame you choose controls how much time it takes to form a candlestick on the chart. For example, on the 1 hour time frame, it takes 1 hour for one candlestick. To form the four prices, we'll tell a story of what happens with the markets within that chosen period. There are mainly two types of candlesticks, the bullish and the bearish candlestick. The bullish candlestick occurs when the closing price is higher than the opening price. The bullish candlestick is usually displayed as a green candle on the chart. The bearish candlestick occurs when the closing price is lower than the opening price. The bearish candlestick is usually displayed as a red candle on the chart. Let's take the example of a bullish candlestick. First, imagine that we are looking at the 1 hour time frame once again. The green box represents 1 hour. The yellow line represents how price fluctuated within that hour. The opening price is the price at the beginning of the hour. The closing price is the price at the end of the hour. The low is the minimum price that the market reached within the hour. And the high is the maximum price that the market reached within the hour. This is where the four prices come from. The distance between the open and the close is displayed in the thick bar known as the candle body. In the case of a bullish candlestick, the distance between the open and the low, and the distance between the close and high, are displayed as thin lines, also known as candle wicks or candle shadows. The distance between the low and the high is known as range. The bearish candlestick works in the exact same way. The only difference is that the close is lower than the open. The wicks or shadows are formed by the distance between the open and the high, and the close and the low. Notice also that this is true for all time frames. Candlesticks can form many different shapes, and each one can have a particular meaning. This leads us to the idea of candlestick. Candlestick patterns are patterns of one or more candlesticks that repeat themselves over and over in the market. And they have a particular meaning and a particular name that helps memorizing them. In this video, I will not talk about all the candlestick patterns because there are more than 50 of them. As I said, I will give you simple and yet powerful examples of candlestick patterns in this video, so you can get a feel of how they work. Candlestick patterns are specific candlestick shapes or combinations of specific candlestick shapes that indicate what's going to happen with price. The first thing to know here is that there are candlestick patterns that indicate a future reversal in price, and patterns that indicate a future continuation in price movements. The most useful candlestick patterns are the reversal type. These patterns usually have a bullish version and a bearish version. The term bullish indicates upsides, and the term bearish indicates downsides. For example, when there is a bullish reversal pattern, price will be going down, and then a pattern will appear to signal a reversal to the upside buy. The same taken in a bearish reversal pattern. Price will be going up, and then a bearish reversal pattern will appear to signal a reversal to the downside. In a bullish continuation, price will be going up, and another pattern will appear to indicate a continuation to the upside. In a bearish continuation, price will be going down, and then a pattern will appear to indicate a continuation to the downside. Let's begin with an example of a reversal candlestick pattern called Harami, which is also known as the inside candle. This is a candlestick pattern formed by two candles. The main thing to look for here is related to the range of the one candle in relation to the range of the previous candle. The rule is that the range of the second candle must be completely inside the range of the first candle. Hence, the name inside candlestick and inside candle simply means that price has stopped advancing meaning. The fact that it is now stationary can indicate a reversal. This is the shape of a bearish harami or a bearish inside. The most recent candlestick will usually be bearish, but there can be exceptions. Take a look at this daily chart of the British pound versus the US dollar. I have marked the range of the last two candles, the first one in black and the second one in red. Notice how the range of the second candle is completely contained inside the range of the first one. Notice also how price has been rising up to this point. This is a bearish harami or a bearish inside candle, signals reversal to the downside. In this other image, you can see what happens with price right after. The bearish harami pattern went straight to the downside, just like the pattern anticipated. Let's observe now an example of a bullish harami or a bullish inside candle. This illustration shows the most recent candlestick. In a bullish harami will usually be bullish, but there can be exceptions. In this chart we have 1 hour time frame of the futures. I have marked the range of the last two candlesticks in the same way I did in the previous example. Observe how the range of the current candle is contained within the range of the previous candle. Therefore, creating an inside pattern, price will going down, and this is a bullish harami pattern. We need that price will be going down, and then the pattern will appear to signal a reversal to the upside. Let's see what happens with price right after the pattern. In this chart, you can see how price immediately reverses to the upside after the bullish harami or the bullish inside candle. The next candlestick pattern I want to talk about is called shooting star, and it's a bearish reversal pattern that is also very common and very reliable. It's a bearish reversal pattern. It appears when the price is going up in order to signal a reversal to the downside. The shooting star is made of only one candlestick, so we have to pay attention to the specific properties of this candlestick. The shooting star has a small bearish body, a large upper shadow, and a non-existent or very small lower shadow. This is a bearish reversal pattern because the candlestick opens, then goes to the upside at some point during the formation of the candle, as it is shown by the large upper shadow, and then price closes slower than the open. All of this means that price went up a little bit and encountered powerful sellers in its upper range. In this chart, we have the 4-hour time frame of Bitcoin versus the US dollar. I marked a clear shooting star pattern after the price has been rising for a while. In this next chart, you can see that the price went down immediately after the appearance of the shooting star pattern. The bullish version of the shooting star is actually called hammer and has a smaller bullish body, a large lower shadow, and a non-existent or small upper shadow. The interpretation is the opposite of the shooting star. The candlestick opens, then goes to the downside at some point during the formation of the candle, as it is shown by the large lower shadow, and then price closes higher than the open. All of this means that price went down a little bit and encountered powerful buyers in its lower range. In this chart, you can see the 5-minute time frame of the United States dollar and the Japanese yen. As you can see, I marked a classic hammer formation after the price has been going down. In this next chart, you can see how the hammer indicated a reversal to the upside with good accuracy. Notice also how I'm giving you different examples in different markets and different time frames. so you can get used to the fact that these patterns work in the same way in any price chart you analyze. Another powerful candlestick formation I want to show you is called the outside candle, also known as the engulfing pattern. This is the opposite of the harami, or the inside candle, in a way. This is a pattern formed by two candles. The main characteristic here is that the range of the second candle must engulf. The range of the first one, the pattern indicates that price will go in the direction of the engulfing candle. In this outside formation, a bullish candlestick will engulf the range of the previous candlestick, as you can see in the illustration. In this image, you can see the 5-minute time frame of the Canadian dollar versus the Japanese yen. Notice that the current candle has a range that completely engulfs the range of the previous candle. And also, the current candle is bullish, implying that there will be a reversal to the upside immediately after the engulfing pattern or the outside candle. We can see that the market started to go up. We also have the bearish version of the engulfing pattern. In this illustration, you can see that a bearish candle completely engulfs the range of the previous candle, therefore. It's indicating a reversal to the downside in this image. You can see the 45-minute time frame. Notice how the range of the current candlestick completely engulfs the range of the previous candle, and how the current candle is bearish, indicating a reversal to the downside. In this next chart, you can see how the bearish engulfing pattern or the outside candle indicated a reversal successfully. As I said previously, these are just a few examples of what candlestick patterns can do. Notice that we began analyzing the elements of an individual candlestick, then we moved on to patterns formed by one or two candles. The logical step here is to learn what happens when we broaden our view of the price chart and observe the patterns formed by collections of candlesticks. And before I show you examples on Quotex, I want to remind you about my Telegram channel, where I share absolutely free trading signals and working strategies. My subscribers are already earning thousands of dollars, starting at $50. And what about you? Follow the link in the description of this video and join us. And let's switch to Quotex. And we can see an uptrend on this currency pair. And if we connect the lows of these candles, we can see that when this level is reached, the price begins to turn around. I think the downward movement will continue, so my first trade will be down here. Great, my first trade is profitable. And as we can see, I managed to predict the price movement. As we can see, the price has reached the support level, and in a few minutes, it will begin to turn around. Let's move on to the next currency pair. And here, I see that the price is at the support level, so my trade will be up here. Great, I'm in profit. And as you can see, there is a global downtrend here. And now the price is at the support level. This is a pretty strong level because the price has already started from it several times. I also want to note here the resistance level that the price has also reached and started its reversal. And there is also a key level here, which was previously resistant, but then was broken through and became a support level. Let's move on to the next currency pair. I see a strong bearish movement on this currency pair, but now the price is at the support level, so I change the investment and open a trade up. Excellent results. I was able to predict the price movements again. Let me show you this level. This is strong enough. As you can see, the price may still go down a bit, so this trade was quite risky, but I still made my profit. Let's look at another situation on another currency pair. And here I see a clear uptrend. All levels are broken. So let's move on to the next currency pair. Oh, this is an awesome situation. I won't waste any time. I change investments and open a trade down. Great. I already have $100 in my balance. This is the first $100 for this trading session. And my downtrade was here because the resistance level is here. Yes, the price could have gone a little higher, but these candles with long wicks indicate that the downward movement will continue. Let's take a look at your one piece and switch to the exchange rate of the United States dollar and Pakistan rupee. Interesting situation. I think I want to open a downtrend here. Great, I'm on profit. And as you can see, here the price starts a correction after a downwards movement. Now, the price is moving in an upwards price channel. At the same time, the price starts from the lower and upper boundaries of this channel. And now the price is at the upper limits of this channel, so my downtrade was here. And guys, I want to remind you about my Telegram channel in which I share absolutely free trading signals and working strategies. If you want to learn about trading and binary options, follow the link in the description of this video and join us. And let's go back to the educational part of our video. Now I want to talk about highs and lows. This leads us to the idea of highs and lows. Anytime you open a price chart, two things become obvious right away. You notice that there are candlesticks in the chart, and that these candlesticks form peaks and valleys, or highs and lows. Your ability to recognize these highs and lows is essential for most good trading strategies out there. For example, take a look. At this chart, there are around 160 visible candlesticks here, and notice how distinctive highs and lows form as new candlesticks are formed. It's always useful to mark these highs and lows. As you can see in this next chart, if we mark the highs and lows and then erase the candlesticks from the price charts, you'll be able to see how there is certain structure. In the markets, being able to identify highs and lows in the price charts is important for a few different reasons. Firstly, you can establish the overall trends of the market by looking at the highs and lows. Secondly, you can identify what are called supports and resistance lines. Thirdly, you can identify chart patterns, so you can detect the strength behind price movements by comparing highs and lows in price with the highs and lows in certain technical indicators. Don't worry if you don't know what all this means, because we'll talk about each one of these four elements right now. Let's begin with the overall idea of markets. We have basically three types of trends that can happen. The bull market or uptrends, which is when prices are going up. The sideways market, which is when prices are moving sideways or in lateral motion. In the bear market or downtrend, which is when prices are going to the downside, we can detect each one of these types of trends by looking at what highs and lows are doing in the price chart. Let's first observe what happens in a bull market or uptrend. In an uptrend, prices rise because buyers have more power than sellers, so the upwards price movements are larger than the downwards price movements. This creates the main characteristic of uptrends, which is the presence of high highs and high lows in the price chart. High highs mean that buyers are strong enough to create progressively high levels in the price chart. High lows mean that buyers are progressively starting the new upward price movements at a higher price. In this chart, you can see a real example of a clear uptrend or bull market. Notice how there are high highs and high lows throughout the entire trend. The next type of trends will be the sideways market, which is characterized by roughly equal upwards and downwards price movements. This means that buyers and sellers have around the same strength. The sideways market is marked by flat highs and flat lows, as you can see in this illustration. In this chart, you can see a real example of a sideways market. Understanding real charts, the flat highs and flat lows are not perfect. What matters the most here? The overall aspect of highs and lows in a downtrend or bear market. The sellers are more powerful than buyers, so the downwards price movements are larger than the upwards price movements. That generates the characteristic effect of downtrends, which is lower highs and lower lows. As you can see in this image, the downtrend is basically the mirrored image of the uptrend. In this chart, you can observe a real example of downtrend or bear market. Notice once again, the lower highs and lower lows as the main characteristic. This finishes off the overall idea of trends. By looking at simple highs and lows in the price chart, we can now move on to a different use of highs and lows, which is to help in the identification of support and resistance levels. Support and resistance levels are horizontal barriers in the price chart. These barriers can be useful for identifying reversal points in the market when prices below a barrier we call it resistance. In this chart, you can see an example of resistance. The first high sets a barrier for price, and then, when price comes back to this level. It treats it as resistance only to reverse to the downside right after when price is above the barrier. We call it support in this price chart. You can see an example of support line. Notice how price touches the line 3 times and then it reverses to the upside. In other words, the support line acts as a barrier. When this barrier is strong enough, price reverses direction after hitting it. You identify support and resistance lines by connecting highs and lows together with horizontal lines. There are 2 important properties of support and resistance lines. 1. The greater the number of times that price respects a support or a resistance line, the stronger the barrier. 2. Support and resistance lines have a switching quality, meaning that a support line that is broken becomes a resistance line, and a resistance line that is broken becomes a support line. In this chart, you can see an example of these 2 main properties in action. Notice how price tests the black line as a resistance a few times. On the left side of the chart, in the middle of the chart, price breaks the line to the upside, and now what was the resistance line turns into a support line. As we can see, in the right part of the chart, price 10 tests the same line as support 2 times and reverses to the upside right after. In this other chart, we can see the opposite happening. In other words, a supporting line turning into a resistance line. Another way how a trader can use candlesticks and highs and lows is by identifying chart patterns. Fire patterns are collections of highs and lows that form particular shapes. In the price chart, these shapes can be used to indicate a reversal or a continuation in the price movement in the same way as candlestick patterns. In this video, I will only give you a few examples of chart patterns, because like candlesticks, there are many different patterns to learn. Fire patterns can be classified into 2 main categories, just like the candlestick patterns: the reversal and the continuation patterns. One of the easiest and most reliable chart patterns is called the double bottom, which is a bullish reversal pattern, meaning that price will be going down and then a double bottom will appear. To indicate a reversal to the upside, there is a very simple logic behind. The double bottom happens when price stops making lower highs and lower lows and all price creates a low. This happens at the same level. As the previous low, the logical interpretation of this is that now sellers are not able to create a low that is lower than the previous one, and therefore sellers are losing strength. If sellers are losing strength, buyers are gaining strength, which might indicate a reversal to the upside. I will show you a classic way of trading this pattern, and I will show you an alternative way of trading this pattern using what we have learned so far about candlestick patterns. Take a look at the charts of the 4-hour time frame of the US dollar versus the Canadian dollar. On the left side, we can see that price was creating lower highs and lower lows, which is typical of a downtrend. In the middle of the chart, sellers attempted to create a lower low, but they failed. Observe how this low is in the same level as the previous one. That's why it begins to form a double bottom formation. Observe also that the candlestick that forms a double bottom is a hammer-like candle that's bullish body in the prominent lower shadow. It means that there are some buyers in the same level of the last low. This is also typical of a double bottom formation or advanced chart pattern. Traders will anticipate that this is a double bottom right at this point and trade right here without waiting for the classic confirmation that this is indeed a double bottom. Notice also that price begins to create flat highs by connecting the highs. We create a resistance line that will serve as a confirmation for the double bottom pattern. The confirmation for the double bottom formation relies on the fact that when price breaks out a resistance line, it starts to treat it as support line. This is exactly what happens here. Price clearly broke the resistance line and then came back to test it as support. This is the moment where classic chart patterns traders will pull the trigger. Notice how the first time. The price tests the support line. There is a larger lower shadow indicating the presence of some buyers. Right after that, we see 3 consecutive inside candles and finally an outside candle pointing to the upside. What I want you to take away from this example at this point is that chart patterns provide some sort of map to traders in the market. The double bottom is a bullish reversal pattern. The bearish version works in the same exact way. As everything is upside down, it is called a double top. Let me show you a variation of the double top called triple top, which is the same pattern. the price attempts to surpass a certain level 3 times instead of 2, like in the double bottom or double top. In this chart, you can see a double top formation that ends up becoming a triple top formation. The first red arrow shows the origin of the resistance line coming from a prominent high in the chart. The second red arrow shows the moments where price comes back to the resistance line. Notice that when price touches the resistance line, it creates a candlestick with a prominent upper shadow in a bearish bottom. This is the shooting star pattern we saw previously, which is a bearish reversal pattern. In other words, price creates a bearish reversal candlestick pattern. It hits a resistance line, and right after that, price goes to the downside star pattern and candlestick pattern. Traders would see this shooting star happening at a possible double top, and they would open a short trade, which would obviously have worked. However, after price goes down, it comes back again to the same resistance line a third time, as it is shown in the third red arrow. Notice that this time it's a little different. Instead of creating a shooting star pattern, price creates 3 haramis or 3 consecutive inside candles, only to finally give up and start going to the downside again via patterns and candlestick pattern. Traders would also see this as a setup for a short trade, meaning the combination of a triple top and 3 consecutive inside candles or haramis. Notice the exception here, that these 3 harami candles indicate a bearish reversal, but they are bullish candles. The third trade will yield an even greater profit from the second one. As you can see in the chart, another interesting chart pattern that is not so famous, but it can be very reliable, is called V-bottom. And V-top is a bearish reversal pattern that is characterized by a sharp acceleration to the upside that is immediately followed by a sharp acceleration to the downside. In this chart, you can see an example of a V-top. Notice how the sharp acceleration to the upside is immediately followed by an acceleration to the downside at the V-top. It's common to find very clear candlestick patterns that will anticipate the reversal. In this case, we can see an inside candle indicating the beginning of the down movement. The V-bottom is the bullish reversal version of the V-top. It's characterized by a sharp acceleration to the downside that is immediately followed by a sharp acceleration to the upside. In this chart, we can see an example of a V-bottom. The important thing to notice here is that the anticipation of the movement to the upside can be made by observing candlestick patterns. In this case, we can observe several candlestick patterns happening consecutively before the reversal to the upside. As I said previously, there are many different types of chart patterns, and each one of them is treated in a specific way. In this course, I'm simply introducing the idea of chart patterns and showing a few of the chart patterns that I find to be more reliable for beginners. And before I show you examples on Quotex, I want to remind you about my Telegram channel, where I share absolutely free trading signals and working strategies. My subscribers are already earning thousands of dollars, starting at $50. And what about you? Follow the link in the description of this video and join us. Here I see that the price is at one of the key levels, so I change the investments and open the trade up. Great, I'm on profit, and as you can see, there is an uptrend on this currency pair. And if you open an uptrade on an uptrend, then it will definitely be a winning one. It's a great situation. Let's move on to the next currency pair. Here I see that the price has started to move down, but it's also at one of the key levels. So my trade will be here. Super. As you can see, 1 minute is enough to make a profit. And let me show you this level. Look, earlier it was a resistance level, but then this level was broken through. And now this is a level of support. That's why my trade was up here. And if you have any questions, write to me in the comments or private messages. Let's look at another situation on another currency pair. This currency pair is flat. I don't recommend beginners to trade flat, but I see a great entry point here, so my trade is up here. Great, I'm in profit, and as you can see, 1 minute was enough to make a profit on binary options. Unlike Forex, where you get profit for points. All you need is to calculate the time to open a deal. And here we can see the level that the price has reached, so my trade was up here. Let's look at another situation on the Quotex. This currency pair has a fairly low payout percentage. Let's move on to the next currency pair. And here is finally a great situation. The price has started a downward correction, but here I want to open an up trade because the price has reached a key level. Excellent result. I already have almost $3,000 in my balance. But my financial goal is much bigger, so I'll show you a few more situations. As you can see, today I don't use any indicators. I rely only on the knowledge of technical analysis. And here you can see an uptrend, but the price has reached the support level, so I think it will continue its upwards movement. Let's look at another situation and switch to another currency pair. And we also see an uptrend on this currency pair. We are already a little late to open a trade, so I want to add another currency pair. Let it be United States dollar and Bangladesh taka. Here we see a strong bearish movement, but let's see what happened a little earlier. We can see that the price is at the support level, so my trade will be up here. Great! As you can see, I got my profit in just a minute. Let's see what is happening with this chart on the higher time frame. For example, on the 3 minutes. And here we can see that the price has a pretty strong support level. The price is already here for the second time. But we can also notice that the general trend in this time frame is upward. Let's go back to the 1 minute time frame again. Let's talk about money management, as it is a crucial part of trading. It's impossible to survive the market in the long term without the proper knowledge of money management, no matter how well you understand and apply trading techniques. Before we move on to more specific aspects of money management, it should be clear to you that a trade has 3 types of orders: the entry, the stop, and the target. The entry order is the price that you in fact get in the market. The stop loss order is a price level that you wish to get out of the market in the case of a loss. And the target is the price level you wish to get out of the market in case of a profit. In the case of a long trade, the stop loss is below the entry and the target is above the entry. In the case of a short trade, the stop loss is above the entry and the target is below the entry. We begin the study of basic money management with the 6 money management parameters you need to keep in mind. They are the initial capital, the percentage risk, which is also known as the dollar risk, the stop size, the trade size, and the risk-reward ratio. The trader must define these parameters in this order. Let's begin with the initial capital. It is simply the amount of money you have to trade, so if your trading account has $10,000, that's your initial capital. That's all. The second parameter is the percentage risk, or the percentage of capital or the fraction of capital that you're going to risk in every trade. For example, the trader can decide to risk 1% of his initial capital in every trade. The third parameter is the dollar risk, which is simply the percentage risk. In terms of capital, the formula for the dollar risk is capital times. For example, if the capital is 10,000 and if the trader sets at 1%, then the dollar risk will be equal to $10,000 times 1%, which equals $100. That means the amount of money you can lose in each trade is equal to $100. The next parameter is the stop size, which is the distance between the entry and the stop loss order. In equities, this is measured in terms of capital. For example, if you open a trade at $20 and the stop loss is at 15, the stop size is equal to 5. Other instruments like Forex and futures are measured in points or pips. For example, the Euro USD, the pip is measured from the 4th decimal case. If your entry is at 1.45852 and the stop is at 1.45802, then you have a 50 pip stop loss. This is important for the calculation of the trade size, which is the next parameter. Size is the number of shares, lots, or contracts to trade so that the stop size represents the chosen dollar risk. This is actually simpler than what it sounds. You can know the trade size following very simple formulas for equities. The trade size is equal to the dollar risk divided by the stop size in forks. The trade size is equal to the dollar risk divided by the stop size times the p-value. Notice that you cannot calculate the trade size properly without knowing the stop size, which implies that you cannot trade properly without a stop loss. After calculating the trade size, you can move on to the final parameter, which is the risk-reward ratio. If you want to survive the market in the long term, you need to choose a risk-reward ratio where the target is a few times larger than the stop. As a standard, you can choose a 1:3 ratio, meaning that the target will always be 3 times as large as the stop. For example, if you are trading Forex and the trade you want to trigger has a stop equal to 20 pips, your target must be 3 times that, which equals 60 pips. For more advanced traders, the risk ratio can vary according to what happens in the market. But since this is a course for beginners, you must choose a good risk-reward ratio and stick to it. Imagine that you use a 1:3 ratio and the first trade you make is profitable. That means you can lose the next 3 trades and still break, even meaning that you can lose the next 3 trades without damaging. We immediately start to look at how many of the trades were profitable in relation to the total number of trades. This is the idea of win rate. In this example, we have a total of 4 trades. 1 is profitable, and the other 3 are not. The win rate is simply the number of profitable trades divided by the total number of trades. In this case, we have 1 profit divided by a total of 4 trades, which equals 25. Notice that this 1 profit is capable of neutralizing 3 losses, that means a break, even which is when you don't win or lose any money. What I want you to take away from this is that you can break even with a 25 win rate by using a 1:3 risk-reward ratio. In other words, even a win rate slightly higher than that will already produce profits. For example, if you use a risk-reward ratio of 1:3 and produce 30 win rate in your trades, you will generate profits. You can make money being wrong most of the time if you use a good risk-reward ratio. In simpler terms, always use a stop, always use a target. Use a good risk-reward ratio once you set the stop and the target, do not change them, and finally let the market hit either the stop or the target, no matter what happens. There are 2 main questions that emerge here. Number 1. How much you should risk in every trade, or what is the optimal? And number 2, what is the best risk-reward ratio? There are advanced ways of calculating the optimal, but since this is a course for beginners, we need to keep things simple. The most important thing about risk is that you must keep it low. Do not risk more than 1% of your capital in one trade. Ideally, you should risk between 1.5 and 1. In each trade, just think, if you risk 1.5% of your capital, in each trade you have 200 consecutive chances of making mistakes. Guys, that's it. I hope this video was useful for you and you learned a lot of new things. Don't forget to like this video and subscribe to the channel. And also, don't forget to subscribe to my Telegram channel, where you can find a lot of useful information about trading and binary options. I wish you all a huge profit. Bye bye.